Welcome back. This is part 2 of the lecture Government Borrowing and Financial Markets. Now let's look at government policy and public debt. There are supporters and opponents of the government borrowing. Supporters of government borrowing give the following reasons. 1, government debt provides financing for necessary capital expenditures. They often take the position that if the debt is going to be used for capital expenditures, that's a form of long-term investment, as opposed to using debt for current expenditures, which are more appropriately financed with current receipts, in other words, taxes. Additionally, economic growth allows for a government to borrow. The stronger the economy, the bigger the economy, the more a government can borrow and justify, just like a corporation that is experiencing growth can handle a larger debt load. Interest payments go up and debt service obligations go up, but cash inflows from operations are also going up. So these are the positions of supporters of government debt. The opponents of government debt, those who say governments shouldn't borrow, will give reasons such as expenditures today are going to be the obligation of future generations who didn't have any opportunity to make the decision as to whether to borrow. So people make the decision today that creates an obligation for others who weren't able to participate in that decision in the future. A second position against government borrowing is that interest payments, the outflows to service the cost of debt, these payments reduce spending on other government needs, both current and capital expenditures. A dollar that goes to interest isn't a dollar that is available for other government needs. A dollar that goes to interest is a dollar that will not be available for other government needs. So there are supporters of government debt and opponents of government debt, and there isn't one universally accepted position on government debt. Now let's look at open market operations. This is a procedure that governments will use to manage economic growth. Economic growth is good to some extent, but too much growth will create inflation, and a government wants to manage economic growth because of the possibility of inflation. So let's see how open market operations does this. When the government wants to slow economic growth, they will sell government securities. Selling government securities requires an attractive interest rate. So the government will move up interest rates to create more interest in government securities. In order for other investment vehicles to be attractive to investors, those interest rates also need to go up, or those rates of return, depending on the investment type, need to go up. And this results in a general increase in interest rates in the economy, and this rate increase then will slow borrowing and investment activity because it becomes more expensive to borrow and therefore more expensive to pursue new economic opportunity, whether at the individual level or at the corporate level. On the other hand, if a government wants to encourage or increase economic growth, they will purchase government securities. Now, the word purchase is in quotations because they're indirectly purchasing securities. Let's see what's happening in this situation. Government reduces interest rates on new government debt. That makes new government debt less attractive, and relatively fewer investors pursue the opportunity to invest in government debt. Now, old government debt is coming due, and often what a government will try to do is manage its maturities with new offerings, so that the money that is coming in from new offerings will pay off the money that needs to go out for maturities. When the government lowers the interest rate on government debt, fewer people invest in new government debt, and that requires the government to come up with more money outside of new issuance to pay off maturing government debt. That's the concept of purchasing. They're not directly purchasing the debt in the market. Rather, they're reducing the total outstanding government debt by reducing the amount of new offering while the maturity of existing debt continues to require paydown. The government reduces its interest rates. That will allow for other investment vehicles to pay lower rates of return. The result is a general decrease in interest rates in the economy, And the lower interest rate makes borrowing less expensive, and a less expensive borrowing encourages borrowing and investment, both at the individual level and at the corporate level. And finally, government debt and interest rates. How does the government view interest rates and the term structure of its debt? Well, the government's preference is to issue long-term debt versus short-term debt, so they have a longer time to pay. It gives them more flexibility. Of course, investors want lower risk, and generally lower risk comes with making a shorter-term loan. So in order to encourage an investor to agree to a longer-term structure, the interest rate should be higher. And therefore, the governments are aware of this. They seek to manage their debt, construct their debt with interest rates and time profiles that match their needs and the needs of investors. And an important need of the government. Not only does the government need funding, but it also needs to make sure that all of its funding doesn't come due at one time. So a government tries to structure its debt portfolio, its borrowings, so that debt is coming due evenly over time, not all at once. And the government will therefore structure the debt profile by adjusting interest rates and the time frame of the debt. Again, investors are generally going to require higher interest rates for longer time periods, so the government will decide when do they want debt to come due so that they can manage their cash outflows so that their maturities come evenly over time. They'll assign an appropriate interest rate to that time structure to encourage investors to invest in that particular time structure of debt, and therefore the government is structuring the debt profile by matching its timing needs to the return needs of the market to invest in government debt at that particular time frame. This concludes our discussion of government borrowing and financial markets. Be sure to work through the exercises associated with this material, and we will discuss in more depth during our case study in class.